So it's time to file your taxes. What do you need to know? In this episode, we go through all the different documents, all the different things to think about as you get ready to file for 2024. It is a must listen to episode.
We hope you've been enjoying all the episodes from Secure Your Retirement. If you'd like to keep learning and receiving these episodes, hit the subscribe button and the bell so you receive alerts when they come out. We've helped thousands of listeners get on the path to securing their retirement. Now it's your turn. Let's dive in.
Welcome to Secure Your Retirement Podcast. We are excited to talk to you about a topic that everybody loves to get ready for, and that is tax season. And whenever we're talking about taxes, and if we ever have the privilege of doing so, we always would like to have somebody who really knows everything about this topic. And so we invited Taylor Wolverton, who is in the office. She's our in-house tax specialist. So thank you very much, Taylor, for coming on board and having a conversation with us about this getting ready for tax season.
Yeah, you're welcome.
Yeah, there's a lot of things to think through. And I think getting ready for taxes can just be super, make people anxious because sometimes you just don't know what you're supposed to do. And it feels, like it's just a bit overwhelming. And you hear all these stories that the IRS is out to get us. And that's probably not the real truth about the whole factor. They do want their money, but they would just love for us to be able to give everything that we need to get together to do this. So we're going to get it started. I'll let Merce kind of kick things off for us.
Yeah, and you get, right around this time of years where you're getting all those things in the mail, tax documents, pay stubs, W-2, all these different things, and people get overwhelmed. So Taylor, could you just kind of walk us through the documents that people should be collecting, either for their tax preparer or for themselves if they're doing their taxes themselves?
Yes. So there are a lot, starting out with a common one I'm sure everyone has experience with. If you're employed at any point during the year, you'll receive a W-2 from your employer showing your wages and things like that associated with that job. And then we also have forms of investment income if you had like interest, dividends, if you sold any securities, things like that in your investment accounts. There are multiple forms associated with that for the interest, the dividends like 1099 INT, 1099 DIV, 1099B. For Charles Schwab, they combine all of those together and they call it the 1099 composite. So there might be something like that if you have investment accounts as well. Those
Hey, can
forms
you
will
real
only
quick
come, yeah.
when you say INT, DIV, could you just tell us what that's actually looking at?
Yeah, so first for the 1099 INT, that'll be interest. So especially if you have like maybe a high yield savings account or a money market account or a CD, something earning interest throughout the year, then your credit union or bank, whatever institution that those cash savings were held at, will issue you that 1099 INT reporting your interest. Similar for the 1099 DIV is for dividends. If you had any investments that gave you dividends throughout the year, paid dividends throughout the year, then those dividends will be reported on that form specifically. And then the 1099B is specifically for capital gains or losses that were realized on the sale of securities throughout the year. So if you have an investment account where there were multiple, maybe you got interest, dividends, and there were some capital gains realized throughout the year, then that's when you might receive that composite that just has everything together combined in one 1099.
And by the way, I will say this, a few years ago, I completely forgot to get that 1099 on my brokerage account. And all of a sudden I got a nasty letter from the IRS saying, hey, you now owe us a lot of money. And reality was I didn't owe them that much money. It's just that they're like, nope, your 1099 income is this, and we don't know what's what. And so we're going to say all of this was a gain. And we're like, no, it was not all of a gain. And so anyway, we had to go back and fix it. And so it is something that I think good if you've got an account like any of those types of accounts you said, hey, you might want to go check. If you didn't get a 1099, maybe reach out and say, where's my 1099?
Mm-hmm. Yes, the 1099 composite, when we're talking about the interest and the dividends, things like that, those will only come from your taxable brokerage accounts. The same is not true for your traditional IRAs or Roth IRAs like that. So for those types of accounts, if you had a traditional IRA or maybe a 401k or a pension, something like that, that you receive distributions from, that's when you'll get a 1099 R for retirement income. So you can expect to find those forms from that account. And the other thing I was going to say too is any form that you receive, any tax form, the IRS also receives a copy of those forms. So when you do get that type of letter in the mail, it's because the IRS also has all of your forms and reconciles
Hmm.
what they see on your forms with what gets reported on your tax return. So if there is a difference or something that the IRS sees on a form that's not on your tax return, then that's when you get those letters from the IRS. So,
The nasty grams, as someone else we know
yeah.
calls it, and because the IRS basically gets it and they say, "Hey, we know about this. Why didn't you report this?" And then that's why you
Exactly.
get that letter.
Yes. With the 1099Rs, also, you will get one if you did a 401k rollover throughout the year. So if you took your 401k account and moved it over to a traditional IRA, your 401k custodian will issue you a 1099R. It's not a taxable event if you did it correctly. It should not be a taxable event, but that form is just to show that the distribution came out of your 401k and changed types of accounts in a way going over to the IRA. So you might see that as well. Then we also have a 1099 SA for Social Security benefits if you, or I'm sorry, 1099 SA for HSA if you had health savings account distributions. That it's easy to get mixed up because Social Security is SSA 1099. So if you get your Social Security benefits or started those throughout this year, then or in 2024, then you'll receive the SSA 1099. And then we also have a 1098. That's for mortgage interest if you had a mortgage this year. And then there's other forms like your K1s if you were part of a partnership or had trust income or S corporation, anything like that.
Which, by the way, on K1s, if you know you're part of a partnership and you know that you're receiving a K1, a lot of heard so many stories of someone who has filed their taxes early, like in February, March, and they forgot that the K1s unfortunately don't come out as quick as 1099s in most cases, and sometimes they come out March, April.
Mhm.
1099s are supposed to be sent out in February. So if you are part of a partnership or you are expecting a K1, don't forget about that because then you have to open up your tax file again and refile to make sure that K1 is accounted for when you get it later on.
Yes.
Okay, so that covers a bunch of documents, and I'm sure everyone here is like, "Oh, well, I hope I have all these together." But they come in the mail, and then the nice part, if you work with the tax preparer, they're also looking for your previous tax return and saying, "Hey, you had this last year. Why didn't you bring me this year?" So there is some checks and balances there. So don't get overly worried. Taylor, what are some of the other documents out there that are not as common or maybe have some misconceptions to them as to what they are?
Yeah, other documents that are important, we have Form 5498. We actually have another episode on this form entirely, but I think it's worth mentioning again. That is a form that you'll get if you contributed to a Roth IRA or traditional IRA throughout the year. Or again, if you did that 401k rollover, you'll receive the 1099-R from the 401k custodian, and then you'll receive the Form 5498 from the custodian where your IRA is held. So that's a way to track different account contributions. And it's important to know the 5498 does not come out until May, and you do not need that form to file your tax return. So you don't have to wait for that form. But if you do get it after your tax return is filed, it's more of a note than anything. It's not something that needs to be reported on the tax return. And then other forms that are important to keep track of, if you made estimated tax payments throughout the year, you'll want to send those to your tax preparer, or if you're doing your taxes yourself, make sure to include that. So we have a record of where all the taxes were paid throughout the year. If you sold any real estate throughout the year, it's important to collect the closing documents so that your real estate properties, if there are taxable gains on those transactions, that can also be reported correctly on your tax return. Same for any self-employment, income and expenses associated with rental properties or rental income, things like that also will need to be reported, that there might not necessarily be an official tax form sent to you, but hopefully you've been keeping records of yourself.
All right. As you can tell, there's a lot of different options that we could have as far as documentation goes. But now we want to transition because sometimes, people will, what does it mean to do itemized deductions versus a standard deduction? So I think first, Taylor, could you kind of give us like what it even means to either itemize or just take the standard deduction, just the difference, and then we can talk about maybe some of the numbers.
Yeah, so the standard deduction is available for everyone who files a tax return, and it's an amount of income that you do not have to pay tax on. So for 2025, we're looking at, I guess, this year now, the standard deduction is $30,000 if you're married filing jointly. So that means the first $30,000 of income that you have, you do not pay tax on. The standard deduction also changes if you are over the age of 65 or blind, it goes up. So it kind of depends on your situation and also changes according to your filing status, but it is something that is available to everyone. And then in comparison to the standard deduction, we have the itemized deductions, which is a list of expenses if they apply to you and are higher than the standard deduction, then that is when you will then have it be more advantageous to you to itemize rather than take the standard.
Okay, well, great. So it's a one or the other. You don't get the standard and get to itemize.
Exactly.
When you add up all your deductions, is that higher than what the standard deduction is, and then that's what dictates do you itemize or take the standard. So what are some of those itemized deductions, the most common ones?
Yes, so we have medical expenses. All of these, I should say, too, are subject to limitations. There's different limitations on each one, but it can also be important to collect documentation associated with your itemized deductions so that you can find out if it makes sense for you to itemize or if you are just going to take the standard deduction just to check that, how that applies to you. So we have medical expenses, state and local taxes that you've paid, property taxes that you're paying, real estate tax that you pay on your home, mortgage interest, and then also charitable donations. So if all of those items add up to more than the standard deduction, then you will itemize. So it does help to be able to add that up and just make sure that you are using whatever gives you the most benefit.
Excellent. So I know that whenever you're meeting with folks and we talk about it in ourselves, just in the planning process, that there is this feature called a qualified charitable distribution that you can do out of your IRA if you're over 70 and a half. So what do I need to make sure that I do if I did do a QCD, as we call it? What do I need to make sure that I tell my CPA?
Yes. Okay. I'm weirdly passionate about this because I never want anyone to miss reporting a QCD correctly. So, yes, if you made any charitable donations directly from your traditional IRA throughout the year, like we talked about, you will receive that 1099-R from your traditional IRA reporting those distributions. But what does not get noted or specified in any way on that 1099-R is the amount that was sent to a charity. So it's very important to communicate to your tax preparer or make sure you're entering this in the tax software correctly if you are preparing yourself to separate out any of those distribution amounts that went to charity so that the charitable amount or the amount that was donated is specified as a non-taxable distribution from that 1099-R. So you have to provide the context yourself because there is nothing to designate charitable donation on your 1099-R.
Got it. So transitioning here a little bit. So to everyone listening, I want to clarify that. So Taylor works for our company, Peace of Mind Wealth Management, and her role is more of a tax strategist. She is not filing the tax returns for our clients. We partner CPAs with our clients to help get that all taken care of for them. But her role is really tax strategy, tax education, coming up with ideas on what can we do this year to make the tax life better for the client. And so I say that because my question here is, I don't want you to think that Taylor has any bias here. It's really just, when it comes to self-preparing, maybe saving a few $100 versus working with a tax professional. Taylor, what's your opinion there? And then also, maybe what have you seen that mistakes happen in the self-preparing side of things?
Yes. If you have any form of self-employment, or if you have a rental property, or if you have partnership income, or maybe with the self-employment you have some sort of business setup associated with that, then those forms to report the self-employment income, the rental income, things like that can get complicated, especially when you're trying to use tax prep software and just file yourself. So that's when, in my opinion, it makes sense to just hire a professional, make sure you're not missing any deductions that would otherwise be benefiting you. With a rental property, you need to be reporting depreciation correctly, and it's important to just have that conversation with a professional tax preparer and make sure that you are not paying more in tax than you need to. Or also, if you just don't want to deal with it and you just want to send somebody else your forms, then hire a professional to take care of it for you.
Yeah, that's 100% me.
Me
I do
too.
not want to deal with it. That is not what I want. Okay. So, every year, here, one of the things that we do for our clients and even those that just know about us is we do a big shred event every year. And everybody brings their old documents and they just get rid of it. And everybody says, man, it feels so good to get rid of all these documents. So when it comes to tax documents, before I head to the shredder, how long should I keep my documents?
Yes, the rule of thumb is to keep your tax documents for at least 3 years. And ideally, even you keep your tax returns themselves for maybe longer than that, but all the forms that go into the tax preparation keep for 3 years. That's the statute of limitations that the IRS has to audit your return. So you want to make sure to have those records for that amount of time at least. And then if you have information for, let's say you purchase securities, stocks, bonds, whatever it is, or even if you've inherited them, it can be important to keep documentation showing the cost basis of those securities, which is the value that you either purchased them for initially, or if you inherited the value of the securities at the time that you inherit them, because that doesn't always get carried over to those tax forms and can kind of get lost along the way. So if you have documentation on the cost basis specifically, then it is helpful to keep that information as well so you can pass that on to your tax preparer when they are reporting that information specifically. So, yes.
All right. So here's a made up statistic that I just came up with. If we talk for more than 20 minutes on taxes, people tune out. So Taylor, tell us what are your last minute thoughts here on, as people are gearing up for tax season and thinking about their 2025 tax year, close us out here.
Yes, just looking forward to 2025. Like we already mentioned, qualified charitable distributions or QCDs, which you're eligible to do if you're over the age of 70 and a half. So if that is something you're interested in, you can contact us about doing that for 2025. And then for estimated tax payments, if you are making payments throughout 2025 as well, the due dates this year are going to be April 15th for the first quarter. Then we have June 16th, September 15th, and then the final Q4 payment will be due January 15th of 2026.
All right. Well, thank you very much, Taylor. We certainly appreciate it. This is, while, taxes can be maddening, we still got to know this stuff. So we appreciate you coming on and explaining it so thoroughly for us. So thank you very much.
Yeah, you're welcome.
We hope you have enjoyed this episode of Secure Your Retirement. If you would like to learn more, we have actually created an online course called 3 Keys to Secure Your Retirement. This video course helps you to think through all the different steps as you get ready to plan for and live throughout retirement. You can access this by going to our website, pomwealth.net. In addition, you can also subscribe below to our podcast called Secure Your Retirement.
For more retirement tips, check out these videos. Also, if you find them valuable, please subscribe to our YouTube channel and give us a like.